So first and foremost, we're going to talk about the stock itself and the company that's behind the stock, and then we'll talk about more of the nitty and gritty before making an investment decision. So here you have Splunk stock, ticker symbol SPLK, and its market cap of $23 billion. Pretty crazy, but definitely nowhere near one of their competitors, which happens to be Microsoft. But we'll talk about that a little bit later in the video. So $23 billion market cap. And as you can see, the price of the stock has been as high as around $225 up here back in August, and has more recently dropped almost half of that to $144. We actually saw as low as $110. So a pretty nice haircut of around 50%. Now, obviously, we're up a little bit from those levels, but this is why I wanted to make this video, is because we did see a nice bump, and so people are wondering, hey, is it a good time to buy? Is it a good time to sell? What's going on with Splunk? So that's what we're going to be talking about today as well. So first, for those of you who don't know what Splunk stock is, Splunk is an American technology company based in San Francisco, California, that produces software for searching, monitoring, and analyzing machine-generated data via a web-style interface. And so more simply, they're a software company that's based out of Silicon Valley. That's what you need to know. But on a more serious note, we can look at their website and see who they are working with. As you can see, some of their partners happen to be companies like Intel, Comcast, Coca-Cola, Arlo, REI, TransUnion, Hyatt, Yelp, and a lot of other big brand names. They advertise that they are trusted by 91 of the Fortune 100 companies. Now that you know that, if this is your first time being introduced to the stock, it might seem like a more safer bet as far as, hey, I want to trust this company too if big and giant organizations trust this stock, right? So that's what leads me into their revenues. This is what we want to look at first, and we'll talk about more about whether this stock is overpriced, underpriced, et cetera, et cetera. As you can see, for the last 5 years, since 2017, they have not made a profit, meaning their net income hasn't reached into the green, right? They're always been negative. That is usually seen as a bad sign from big Wall Street analysts. Now, for a company that's growing in size and wanting to grow the revenue, which as you can see, they've obviously done over the last 5 years, you do have to spend some money. And it's interesting to see that as they've grown the revenue, so has their net income just fallen down and down. And this year in 2021, their revenue has actually dropped quite significantly versus the previous year, at the same time as net income dropping further down. Now, the nice thing is this year's not over, and we'll most likely see the revenue numbers jump quite a bit. And if their net income goes down as well, we might see that correct above the 2020 levels. That's just something to pay attention to as you're thinking of investing into this stock. Now, if we scroll up and take a look at their PE ratios, you can see they don't have one. And for good reason, because technically they haven't ever made a profit. So their PE ratio is negative 21.7. But the interesting thing is, over the last 5 years, Splunk's average PE ratio was negative 50. So they've actually brought that up quite significantly, and I hope to see them bring that up over the next few years. So if you're a long-term investor, this is what you have to pay attention to. As long as their PE ratio is moving in the right direction, that's good for their stock. Now, you're probably wondering, well, how much debt do they have? We'll get into that in just a second. First, let's look at a positive, which is their valuation. They're actually sitting pretty well undervalued for their revenue. Their current share price is around $140. Meanwhile, their fair value is around $230, which makes them 37% undervalued, which is nice to see if you're thinking about maybe picking up some shares. Obviously, this is not financial advice, but just a nice positive for you if either you bought shares back when it was higher priced or if you're thinking about buying in for the first time. So future growth. Future growth is something that's also good to pay attention to. As you can see, they are going to decline in overall earnings, but the revenue is subject to grow. And soon, more specifically around 2023, 2024, they should start seeing about a 2x in revenue from what they're doing today. And their earnings will start to go up as well. We're talking about net income, of course. But the projected growth is 27%, which is pretty nice for a company of their size already. Now, I promised you guys the balance sheet and the competition. So here is their balance sheet on the screen. As you can see, their debt is pretty big, $2.3 billion. Now, when compared to their long-term and other assets, it's also $2.3 billion. But when you compare it to their cash, meaning how much money could they just liquidate right now and pay off their debt? Well, that's only $1.9 billion, so they'd still be left with $400 million in debt. That's not always a pretty sight to see. Normally, I would say I'd like to see their debt go down quite significantly. This is pretty hefty and kind of makes me, as an investor, a little bit nervous. So like I said, pay attention to the next few quarters and definitely make sure to watch what happens to this debt bubble as the next couple quarters roll in. So the debt to equity history on this type of chart, as you can see, in 2018, they had no debt. Nearing 2019, their debt increased a lot. And ever since then, it's been on an uptrend. And in fact, their debt to equity ratio is now a little bit out of control. It's 186%. Honestly, anything above 40% is considered a high debt to equity ratio. So that is likely one of the big catalysts for why this stock has dropped so much and continues to be so undervalued. So before we talk about the competition and the CEO for the company as well, I want to look at the ownership breakdown. As you can see, institutions and the general public pretty much own 100% of this stock. We're talking about 98, 99% of the stock is owned by those two groups. And so what does that tell me? Well, that tells me that institutions can pretty much do whatever they want to this stock's price. So what typically happens is if one institution decides to sell out, one of two things will happen. Either one institution will pick up those shares, meaning the stock price won't go down very much, but typically what happens is one institution sells and a few others follow. So that's one thing to kind of be wary of. If you see an institution selling some of their position, make sure to be ready for a drop in price. But I don't think that will happen because, for example, the Jim Simmons Renaissance Fund actually bought up shares very recently and they're still not positive. And the companies that bought in the higher ranges expecting this price to go up are likely still in the negative and probably won't sell out until this company starts to actually bring in money and return a nice profit for their portfolio. But that's not always the case. Some hedge funds do need to take some money out from time to time, and sometimes cutting your losses is a big strategy that they will take advantage of. So just something to note and remember for the future. Now, Douglas Merritt is the CEO of Splunk. If you haven't heard of him, don't worry because not everyone is familiar with every CEO out there. But when you take a look at his job history, we can see that he has been on the board of Cisco. He was the senior vice president for Cisco, which is really cool. And Splunk happens to be the company that he's been at for the longest. So hopefully he ends up staying there. But it looks like his tenure has been anywhere from 1 year all the way up to 6 years. And since he's been there roughly 6 to 7 years now, he's either going to retire there, which is hopefully what we want to see. We want to see a CEO that stays with the company for a long, long time, or he might move to a different company. And that's something that we do not want because that usually shows weakness in a company. So we don't want to see that. Hopefully he stays there for a long time. And obviously he's been in that business for quite some time as well. So that makes me feel at least somewhat confident that he does have the merit to do a good job. Now, when we talk about competition, we can see that Splunk has some big names to compete against, including Microsoft, IBM, BMC, which is the company he used to work for, Intel, Datadog, Elastic, and VMware. Now, this is cool. If you do have your phone app, if you want to take a look at it, this shows the CEO rating based off of a few different metrics. Also, it shows you the number of employees that the company has, the amount of funding, and the amount of revenue that each company does. And when you take a look at this, you can see that Splunk is kind of one of the underdogs. I mean, VMware does $11 billion in revenue versus Splunk with $2.2 billion. Now, the same thing can be said about Elastic and Datadog, which both have a lot less in funding and a lot less in revenue than Splunk. But like I mentioned before, Intel, Microsoft, IBM, even ServiceNow, all these other companies have a lot more revenue coming in currently than Splunk. So now that you know who they're competing against, let's talk about their growth over the last year. Now, this is Splunk's first quarter financial highlights. Now, their cloud ARR, which is annual recurring revenue, was $877 million, up 83% year over year. Now, their total ARR was $2.47 billion, up 39% year over year. Cloud revenue was also up 73% year over year, and total revenues were up 16% year over year. So when you combine all those things and you average them out, they're definitely beating their expected growth rate of 27%, like we discussed earlier. So if they can continue this kind of growth, that would be absolutely fantastic for the company. And if they can eat into their competition stake, meaning the revenue that the other companies are doing, then they can definitely take up some of that market share of virtually billions and billions of dollars, almost if not $1 trillion of market share. And just taking 1% of that $1 trillion market share, they would be doing around $10 billion in revenue versus what they're doing now, which is only $2.2 billion. Now, that doesn't mean that they're going to be in the positive when it comes to net income, because they have a history of kind of being in the negative, and it shows with consistency at this point that it's not just, hey, we're going to do well one quarter and then we're going to do bad another quarter. It's pretty much every single year that they've been net negative. But again, they do have some big names that they're competing against, and they do have a lot of market share that they could eat into. Now, you're probably wondering, well, what about their stock price, right? So we know why it's undervalued. You know that the price of the stock has fluctuated because they have increased their debt quite drastically. At the same time, as a decrease in revenue for the first time in a while, that makes investors a little bit wary and a little bit nervous, if you will. So that's kind of me being the devil's advocate. But as far as like, where would I buy this stock? Well, as you can see from a technical analysis standpoint, you can see that once it touches these levels down here in the low $100 range, you can see that it usually pops off pretty nicely, right? We saw this 102 back here in April, and it popped off nicely all the way to 220, 230, and back here as well when it touched $91, and even right before that to $89, and it hasn't had a lower low. From a technical analysis standpoint, long term, that's a really good sign. Now, that doesn't mean that the stock is just going to go straight up past its previous high. It does have some things to prove in the next couple of quarters for big institutions to continue keeping their money in Splunk. That's going to be a big make it or break it point. But personally, if I were to get into the stock, obviously I'm a long-term investor, so I'm always dollar cost averaging into companies, right? So that's something that I would definitely keep in mind. And also when I see them dip, so if I could see a $120 Splunk, I would buy heavy because we might not see a lower Splunk again. That's only to say if they actually return good profits during the next couple of quarters. Otherwise, I wouldn't be buying the stock, period. I'd probably sell out of my positions if I saw bad quarters, along with the CEO maybe leaving and other institutional buyers selling, especially at a loss. So those are all things to pay attention to if you want to get into the stock. Again, it's not ever financial advice, but I definitely could see this stock getting into the 40, 50, $60 billion market cap, especially when we're considering that it has the potential to reach $10, $20 billion in revenue if they can continue growing their business at the same time as eating into the overall market share of that $1 trillion market cap that we talked about as far as when it comes to this entire industry as of right now. Obviously, that will also grow with time, so they don't necessarily need to eat into competition, but it always helps, especially when we're talking about a company like this, which just happens to be an underdog in their field. So if we did reach that $50 billion market cap, obviously we would be seeing around a $290 to about a $300 per share Splunk stock. And as the data analysis and monitoring industry grows, which I think it's about to have an insane boom, I think that this stock has well above that potential. As far as like the actual nitty and gritty numbers, I think it could easily reach $50 billion in market cap. But if it also gets overinflated by increasing numbers and maybe CEOs staying around, and then institutional investors keep coming in and buying up more shares, just like with many other hyped up industries like we saw with EVs not too long ago. And around the same time, MJ stocks had the same exact experience. The propped up valuation could get as high as 200, 300, and 400 billion dollars. Now, that sounds like an insane amount for a company that's not doing a lot in revenue and is also not net positive, but those are the numbers that could theoretically happen in the next couple of years if those catalysts do come into play. I mean, if we can see stocks like GameStop, AMC that are virtually on the brink of bankruptcy, at least in the next 5-10 years, and we saw them have a massive run up, then why can't a company with good fundamentals, and as long as they can continue growing in their space, I think they could definitely climb to those type of levels. But this is not one of those stocks that is going to be an easy ride. This is a stock that's been pretty volatile in its history, but again, I like what they have to offer. I think that they have a lot of potential and a lot to prove.